Hi everyone, good morning. My name is Deepak Bisht, and we are discussing the investment banking question and answers, merger and acquisition advanced questions. So previously we did uh, completed question number 9, but later on I thought this question was tricky. So these advanced questions are tricky, uh, and that's why I would like to revisit this question number 9 one more time. So question number 9 is about the complete formula of how to calculate goodwill in merger and acquisition deal. So if when you look at the formula here, so the goodwill formula includes equity purchase price. We sell the seller's book value. We add back the seller's existing goodwill. Then we subtract the asset write-ups. Then we subtract the seller's existing DTL. We add back the write-down of seller's DTA, and we add back the newly created details also. So this is a big formula, and I have broken this formula down into simpler steps. So let's discuss that. Okay. So first of all, we need to define terms, and there's going to be an algebraic formula also, algebraic example also along with this. And then we will run a numerical example, and we will end it with implications for the post-deal accounting and valuation. All right. So here the formula was, so goodwill is equal to equity purchases. We sell the seller's book value, add back seller's existing good value. And why do we do that? And everything in the all the components in the formula. So see, goodwill, when we discuss about goodwill, so goodwill is actually it's basically consideration transferred, which is the money that we are paying to the company. Then we add back the non-controlling interest, and then we add back the previously held interest also. So when we add all these three, we get the equity purchase price. Understand this thing? And from the equity purchase price, we subtract our fair value of all the net identifiable asset acquired, because if you remember, we discussed about the purchasing. We discussed about when we uh, do a purchase, we the goodwill is created because of the difference between the market value and the book value. So, okay, let me just show you the question we discussed. Purchase accounting and pooling accounting. So, goodwill is created because of purchasing accounting. In pooling accounting, no goodwill is created. So, coming back to the question, see, now let me just break it down. So, consideration transfer, when we break down the considerable transfer plus equity interest plus previously handed interest, that is the equity purchase price. And when we break down the equity purchase price, so other components, when we look into the other components which are there, so there's going to be seller's book value, then the seller's existing goodwill, then there's going to be asset write-up, then there's going to be seller's existing DTLs, then there's going to be write down of the seller's DTA, and a newly created DTL, which is nothing but this value, the fair value of the net identifiable acquired assets. Okay, so think about this. Intuitively, goodwill is the premium the buyer pays for a target above the market value of the identifiable asset and liabilities, and acquired. It reflects intangible benefits. Goodwill is actually intangible benefits. Pardon my handwriting. Uh, That's why I try not to use stylus because of my bad handwriting. So the goodwill is actually something intangible, and that are not separately recognized on the acquired company's balance sheet, like things like brand and assembled workforce or customer relationship, expected synergies, and other identifiable values. So formally, goodwill is actually this formula: consideration transfer, non-controlling interest, previously held interest, and then we subtract this fair value of net identifiable asset acquired. And in most in simple 100% equity purchases with no previously had interest. So if we are saying that if it was 100% equity, if we would have used 100% equity, so this would be simply broken down into equity purchases and the fair market value of the net identifiable assets. And the practical formula here is this one, which is used in the common practices. So let me just break down one more time. So equity purchase is this is the cash. Let me just this is the cash and the other consideration that the buyer pays to acquire the equity, the seller's book value. So the seller's book value is the seller's shareholders' equity. Understand this thing. So shareholders' equity is actually the purchase price and we subtract the book value. So that's the shareholders' equity. And after that, the shareholders' existing goodwill, we added back the goodwill already appearing on the seller's is not separate, transferable, identifiable asset for the acquirer. So in consolidation process, the seller's historical goodwill is written down to eliminate it. So this will be written down. The acquirer's goodwills are subsummed. So however, because the purchase price implicitly include whatever was captured by that historical goodwill, so we added back when recording we when we reconcile the seller's book value to the purchase price basis and think of it as a reversing of an old accounting entry, so we can remeasure everything at a fair value. So this is not a separate entity, and that's why we added back. And now the asset write-up. So in acquisition, we measure the identifiable asset at fair value, and this should be at fair value. All right. So asset is going to be writing up. And when we talk about the fair value, so asset, there is a possibility that the asset will be written up. And because the asset is written up, okay, we will discuss it later on. So this is going to be that's why we subtract it. This is going to be a subtraction because the asset value, this will be later on impacting on the depreciation. This will increase the depreciation. And why? Because, okay, so this is in this concept we haven't talked about. So understand this thing. So if the value of a building today is 100 million and I am writing up asset write-up, I am doing an asset write-up. So I am saying that the building's worth is now 150 million. So understand this thing. Previously, we were at a 10% rate and the life of 10 years. We are assuming in a simple straight line depreciation, I'm saying that it's $10 million every year depreciation and $10 million every year depreciation. But now, out of sudden, I am assuming now I am writing up my asset and I'm saying that the asset's value is 150 million. So I will be starting to pay $15 million depreciation. But what about the retrospective adjustments? What about that? So that's why asset write-up creates a deferred tax liability. This we have discussed previously also. So if we are writing an asset, so now we are liable for the previous years Okay, this means that we did a mistake here when assessing the life of the life or the fair value. If we are talking about the fair value, let me just remove everything because we do not have much space. Mm, and yeah, I actually do have to remove everything. So I hope this makes sense. So we need to subtract this because this is going to be, and this is going to have a negative impact on the goodwill. And because we actually have to pay this money to the government, so we will not include it in the into the goodwill. And after that, let's talk about the seller's existing deferred tax liabilities. So if the seller actually do have existing deferred tax liabilities, then we need to not include, we will not include it because see, goodwill, this doesn't have any long-term impact. This doesn't helps us. So we need to expenses out in the goodwill section. So many book to tax temporary differences creates DTL on the seller's book, and in acquisition consolidation, these existing details may be de-recognized depending on tax basis and the transactions also. So removing an existing liability reduces the liability side of the net assets, and therefore it reduces the net identifiable liabilities and decrease the goodwill. And during the merger and acquisition process, so let me just give you a brief example here. And I wanted it I mean, I was thinking about it. So assets are there, liabilities are there, and liabilities and equity is there. So once you have acquired a company and you are saying that, let's assume $10, $10 million of goodwill you have created. You also need to balance your balance sheet. So this is going to impact your liabilities and equity because assets should equal to liabilities plus equity. And you need to make adjustments here and there everywhere. So I hope this was clear. Understand this thing. So you will adjust as much as possible in the goodwill when calculating the goodwill. And this is also, um, this is actually obvious that the government would also be looking into how much you have claimed as goodwill. Let's not digress from the topic. So sellers existing DTL. So we will decrease the seller's existing DTL because uh, DTLs are created because of the above factor when we write up the asset. And there could be, we actually have to look into the seller's financials to understand why there was a DTL in the first place. Uh, And after that, okay. So after that, we write down the seller's DTA. So DTA, if the acquirer determines that some of the seller's DTA are not recoverable, for example, because future taxable income is unlikely, so we write them down, and writing down DTAs reduce assets actually, and therefore you need more goodwill to balance. Hence, DTA write downs are added in the formula. This is why it's added down, and this will be helping us. And newly created details after the merger and acquisition process, we will add it back. And when you write up asset to fair value, you often create temporary DTL because we are, so this goodwill only will be created if we are doing a purchase. Uh, we are buying the company's assets on a fair market value. Okay, let me just fix it. Fair market value, and then only goodwill will be created. So understand this thing. This is how this formula makes sense. Now this formula makes sense. So uh, we start from equity purchases. This is how much we have given this is the consideration, the cash. This is the cash. From the cash, we are selling the seller's book value. So book value, we are also, so seller's book value means the equity value of the shareholders of the existing company. So we do not care about it because we have already, when we are acquiring or merging with a company, you already purchased the equity. So you will actually remove this component. Seller's existing goodwill, we will add it back because the goodwill already appearing on the seller's book is not it's not separate to transfer and it's not transferable or identifiable asset for the acquirer, so we need to add it back. So seller's goodwill, okay, why we add it back? Understand this thing. Let's assume I am a financial institution. I am a bank. Let's say I am JP Morgan. I am acquiring a smaller bank now, investment bank, assume. Morgan Stanley's investment banking I am acquiring. I'm acquiring Morgan Stanley investment banking. So if they have some amount of $100 or $100 million of goodwill in their balance sheet, so when I acquire this, this will be a plus point for me also. So that's why if I actually have a goodwill of 150 and when I acquire this company and I get a 100 goodwill of 100 also along with the other company, so I will add it back into my balance sheet. Then we will subtract the asset write-up. We will subtract the existing DTL because we are not sure uh, whether or not we will be able to realize those in future. So we will subtract it back, and then we will add back these things. Write down of seller's DTA, and we will add back the creation of new DTL because when we purchase a company at a fair market value, this is obvious. This is very obvious. This is going to be created. So let's go to the question again and okay, that's the problem. So I need to remove everything. Okay, okay. So this was the problem. That's why I was not using it. Okay, if we talk about the question one more time,